Well, on March 14th, 2025, the Bank for International Settlements released a 247-page report that 99% of people will never read. Page 187 contains a single paragraph about 4.7 trillion in what they call hidden leverage sitting inside the global derivatives market. Not projected, not estimated. Actual exposure that exists right now, today, built into the financial system like a time bomb with no timer. And here's what makes this terrifying. This exact structure has detonated 3 times in modern history. 1987, 1998, 2008. Same leverage mechanism, same hidden risk, same catastrophic unwinding. But this time, the exposure is 340% larger than 2008. While you were scrolling social media yesterday, the Federal Reserve, the European Central Bank, and the Bank of Japan held an emergency coordination call. They didn't announce it. They didn't need to. The smart money already knows what's coming. Because there's a pattern here, a mathematical certainty that plays out in markets the same way gravity works on falling objects. It doesn't care about your opinion. It doesn't wait for permission. It just unfolds. And right now, we're at the exact same point in the cycle where, historically, everything breaks. Stay with me, because in the next 18 minutes, you'll see the precise mechanism that transforms a $4.7 trillion problem into a complete system failure. And you'll understand exactly which 72-hour window will determine whether you're positioned correctly or caught in the blast radius. Let me show you something that, once you see it, you cannot unsee it. Every major market collapse in the last 40 years follows the exact same 7-stage pattern. Not similar, identical. Stage 1, cheap money floods the system. Stage 2, leverage builds in obscure instruments nobody's watching. Stage 3, returns get so good that everyone assumes it's the new normal. Stage 4, the first crack appears, but institutions insist it's contained. Stage 5, contagion spreads faster than anyone predicted. Stage 6, forced liquidation creates a death spiral. Stage 7, wealth transfers. From those who believed the system to those who understood the pattern. This isn't theory, this is documented market behavior that repeats with mathematical precision. 1987, portfolio insurance, a derivative strategy that was supposed to protect investors, automatically sold stocks when prices fell. Brilliant idea, safe, mathematically sound. Until October 19th, when it created a feedback loop, stocks fell, which triggered automatic selling, which made stocks fall more, which triggered more automatic selling. The Dow Jones dropped 22.6% in a single day. $500 billion evaporated. But here's what nobody tells you. The total notional value of portfolio insurance contracts was only $60 billion. A relatively small derivative position took down the entire market because of how it was structured. Same pattern, 11 years later. 1998. Long-term capital management. A hedge fund run by 2 Nobel Prize winners and the former vice chairman of the Federal Reserve. They built mathematical models that said their strategy was so safe, they could leverage it 25 to 1. They were trading derivatives based on tiny spreads between government bonds. But with $125 billion in positions, those pennies added up. Until Russia defaulted on its debt in August 1998. Their model said that was statistically impossible. The models were wrong. LTCM's positions unwound so violently that the Federal Reserve had to organize a $3.6 billion bailout, not to save the fund, but to prevent their forced liquidation from destroying every major bank on Wall Street. The fund had $125 billion in derivative positions. The total global GDP was $31 trillion. They were 0.4% of the world economy and almost took down the entire financial system. Now watch the pattern accelerate. 2008, credit default swaps. Banks created derivatives that let you bet on whether mortgages would default. Insurance, basically. Safe, diversified, mathematically sound. Until housing prices stopped going up. Then the same feedback loop. Mortgages defaulted, which triggered CDS payments, which forced banks to sell assets, which crashed asset prices, which caused more defaults, which triggered more CDS payments. Lehman Brothers filed for bankruptcy on September 15, 2008. Bear Stearns collapsed. AIG required a $182 billion government bailout. The total notional value of credit default swaps at the peak, $58 trillion. Global GDP was $64 trillion. We built a derivative market almost as large as the entire world economy. And when it unwound, $10 trillion in household wealth vanished in 18 months. 3 times. 3 different instruments, same 7 stages, same mathematical certainty. But here's where it gets terrifying. The Bank for International Settlements report from March 2025 identifies $4.7 trillion in what they call basis trade leverage in the U.S. Treasury market. Let me explain what that means in plain language, because this is the most important thing you need to understand. Hedge funds are borrowing money to buy U.S. Treasury bonds, then simultaneously selling Treasury futures contracts to capture the tiny difference between the cash price and the futures price. The spread is usually 2 to 5 basis points, 0.02% to 0.05%. Nothing. But when you leverage that position 50 to 1 or 100 to 1, those basis points become real money. According to the Office of Financial Research's December 2024 report, the average leverage ratio in these trades is now 73 to 1. That means for every $1 of actual capital, hedge funds control $73 of Treasury bonds, $4.7 trillion in leveraged positions. That's 16% of the entire $29.6 trillion U.S. Treasury market. Now here's the mechanism that makes this catastrophic. These trades require daily margin. If the basis spread moves against you, you have to post more collateral immediately. During normal times, no problem. The spread is stable, everyone's making money, life is good. But if something disrupts the Treasury market, if volatility spikes suddenly, if the spread moves even 10 basis points in the wrong direction, those hedge funds get margin calls. Billions of dollars of margin calls, simultaneously. And here's what nobody's talking about. To meet those margin calls, they have to sell treasuries, which drives treasury prices down, which creates more volatility, which triggers more margin calls, which forces more selling. The exact same feedback loop as 1987, 1998, and 2008. Same structure, same mathematical inevitability, same death spiral. Let me show you how this played out in real time once already. March 2020, COVID hits, markets panic, investors rush to safety. U.S. Treasuries are supposed to be the safest asset on earth. They should have rallied. Instead, on March 12, 2020, Treasury yields spiked violently. Prices collapsed. Why? Because hedge funds running basis trades got margin calls and had to dump treasuries to raise cash. The safest asset in the world became a forced seller's market. The Federal Reserve had to step in and buy $1.6 trillion of treasuries in 6 weeks to stabilize the market. That was with approximately $650 billion in basis trade leverage, according to the Fed's own estimates. We now have $4.7 trillion, 7 times larger. The Fed bought $1.6 trillion to stabilize a $650 billion problem. Do the math. If the basis trade unwinds today, the Fed would need to buy approximately $11.6 trillion of treasuries to prevent a complete market collapse. The Fed's balance sheet is currently $6.8 trillion, down from the $9 trillion peak. They don't have $11.6 trillion, they'd have to print it instantly. Emergency quantitative easing on a scale that makes 2008 look like a practice run. Now let me show you where we are in the 7-stage pattern right now, today, January 29th, 2026. Stage 1. Cheap money floods the system. Check. Interest rates were near zero from 2008 to 2022. 14 years of free money. Stage 2. Leverage builds in obscure instruments nobody's watching. Check. Basis trades grew from $180 billion in 2018 to $4.7 trillion in 2025, according to BIS data. Most investors have never heard of basis trades. Stage 3. Returns get so good that everyone assumes it's the new normal. Check. Hedge funds running these strategies have posted consistent returns of 8% to 12% annually with supposed minimal risk. Assets under management in basis trade strategies have tripled since 2020. We're currently in stage 4. The first crack appears, but institutions insist it's contained. On January 15th, 2026, the Treasury Department's quarterly refunding announcement revealed they're issuing $1.4 trillion in new debt this quarter alone, the highest quarterly issuance in history outside of 2020. That supply hits the market while hedge funds are holding $4.7 trillion in leveraged long positions. Supply and demand, basic economics. More supply means lower prices. Lower prices mean those basis trades start losing money. On January 22nd, 2026, the spread between cash treasuries and futures widened to 8.3 basis points, the widest since March 2023. Bloomberg reported that 3 mid-sized hedge funds received margin calls totaling $340 million. The institutions are saying it's contained. The Fed's latest financial stability report from December 2025 mentions basis trades exactly once in a footnote on page 143. They call it a source of potential liquidity stress, but conclude the risk is manageable given current market conditions. That's the exact language they used about subprime mortgages in 2006, the exact language they used about portfolio insurance in 1987, the exact language they used about LTCM in 1998, manageable given current market conditions. But here's what the data actually shows. The Federal Reserve's own stress test scenarios, published in their June 2025 supervisory stress test results, modeled a scenario where Treasury yields spike 200 basis points. In that scenario, they estimate approximately $680 billion in hedge fund losses. But their model assumes an orderly unwinding over 90 days. It assumes hedge funds can meet margin calls without forced selling. It assumes the basis spread stays within historical norms during the unwinding. Every single one of those assumptions is wrong, and history proves it. March 2020, the basis spread moved 15 basis points in 72 hours. Forced selling started immediately. There was nothing orderly about it. 2008, Lehman Brothers had 72 hours from "we're fine" to bankruptcy. LTCM in 1998 went from "our models are perfect" to "we need a Federal Reserve organized bailout" in 6 weeks. The unwinding is never orderly. It's always faster and more violent than the models predict. Now I know what you're thinking. But the Fed can just step in like they did in 2020. They'll buy treasuries, stabilize the market, problem solved. Let me show you exactly why that doesn't work this time. March 2020, when the Fed intervened, inflation was 1.5%. They could print $1.6 trillion without worrying about currency debasement. Today, January 2026, core PCE inflation is 2.8%, according to the latest Bureau of Economic Analysis data. The Fed just spent 2 years fighting inflation, raising rates from 0% to 5.5%, shrinking their balance sheet. If they suddenly reverse course and print $11.6 trillion overnight, they destroy their inflation credibility instantly. The dollar would collapse. Foreign central banks holding $7.6 trillion in U.S. treasuries would panic. You can't fight inflation for 2 years and then print $11.6 trillion. The currency implications are catastrophic, but it gets worse. The Fed's primary dealer system, the mechanism through which they buy treasuries, has less capacity than 2020. According to the Federal Reserve Bank of New York, is January 2026 primary dealer statistics. Total dealer inventory capacity is $89 billion. In 2020, it was $127 billion. The dealers physically cannot absorb the selling pressure from a $4.7 trillion unwind. The infrastructure doesn't exist. And there's one more thing nobody's talking about: Japan. The Bank of Japan has been the largest foreign buyer of U.S. treasuries, holding $1.13 trillion as of November 2025. But on December 19, 2025, the Bank of Japan raised interest rates for the first time in 17 years. Japanese government bonds now yield 1.2%. U.S. treasuries yield 4.5%. But when you factor in currency hedging costs, which are currently running at approximately 3.1%, according to Bloomberg data, the hedged yield on U.S. treasuries for Japanese investors is about 1.4%. JGBs yield 1.2% with zero currency risk. The math changed. Japanese investors are starting to sell U.S. treasuries and buy JGBs. In December 2025 alone, Japan sold $43 billion in U.S. treasuries, the largest monthly selling since June 2022. So you have $4.7 trillion in leveraged long positions that will be forced sellers if volatility spikes, plus the largest foreign holders starting to reduce their position, plus the Fed unable to intervene without destroying the dollar, plus record treasury issuance hitting the market. This is stage 4. The crack is visible. Institutions are saying it's contained. History says what comes next is stage 5. Contagion spreads faster than anyone predicted. Let me show you the transmission mechanism, the exact sequence of events that transforms a treasury market problem into a complete system failure. It's not theoretical. It's documented from every previous crisis. Step 1. Margin calls hit hedge funds running basis trades. They need billions in cash immediately. Step 2. They sell treasuries to raise cash. They're not the only ones selling. Volatility is spiking, so risk parity funds automatically reduce treasury exposure. Pension funds rebalancing. Insurance companies meeting redemptions. Everyone's selling at the same time. Step 3. Treasury prices fall violently. But treasuries are the collateral underlying the entire financial system. When treasury values drop, the collateral backing $26.3 trillion in repurchase agreement, repo transactions, loses value. According to the Fed's latest financial accounts of the United States data from Q3 2025, total repo market outstanding is $26.3 trillion. Step 4. Repo lenders demand more collateral. Borrowers can't post more collateral, so repo lending freezes. Step 5. Without functioning repo markets, banks can't fund their daily operations. Liquidity crisis. Step 6. Banks stop lending to each other. Credit markets freeze. Step 7. Corporations can't roll over commercial paper. Payrolls at risk. Step 8. Forced asset sales across all asset classes. Stocks, bonds, real estate, everything. Death spiral. This isn't speculation. This is the exact sequence from 2008, documented in the Financial Crisis Inquiry Commission report, published January 2011. The repo market froze, credit markets seized, and the entire system nearly collapsed. But in 2008, the problem started in mortgages, a $10 trillion market. This time it starts in Treasuries, a $29.6 trillion market that serves as the foundation for $280 trillion in global financial assets. When the foundation cracks, everything built on top of it collapses. Now let me show you the 3 indicators that will tell you exactly when we're moving from stage 4 to stage 5. These are not predictions. These are mathematical certainties based on market structure. Indicator 1, the MOVE index. It measures implied volatility in the Treasury market, basically a fear gauge for bonds. Normal range is 80 to 120. In March 2020, when basis trades started unwinding, the MOVE index hit 165. As of January 28, 2020, Essex, the MOVE index is at 118. Watch for a move above 140. That's the tripwire. Above 140, margin calls accelerate, forced selling begins, feedback loop initiates. Indicator 2, the Treasury basis spread itself. Currently at 8.3 basis points. Historical average is 2 to 3 basis points. In March 2020, it hit 62 basis points before the Fed intervened. Watch for a move above 15 basis points. At 15 basis points, hedge fund losses exceed their capital cushions. Forced liquidation becomes mandatory. Indicator 3, repo market stress. Specifically, the spread between the secured overnight financing rate, SOFR, and the Fed funds rate. Normal differential is 1 to 3 basis points. In September 2019, when repo market seized, the spread hit 282 basis points. Currently, as of January 28, 2026, the SOFR Fed funds spread is 4 basis points. Watch for a move above 20 basis points. Above 20, repo lenders are getting nervous. Above 50, panic is starting. These 3 indicators are your early warning system. The MOVE index, the basis spread, the SOFR spread. You can check all 3 for free right now on the Federal Reserve's website and Bloomberg's public data. When all 3 flash simultaneously, you have approximately 72 hours before stage 5 becomes unstoppable. Now let me show you what the smart money is already doing. Not what they're saying, what they're actually doing based on public filings and institutional transaction data. According to 13F filings released in mid-November 2025, covering positions as of September 30th, 2025, Bridgewater Associates, the world's largest hedge fund, reduced long-duration Treasury exposure by 37%. They increased cash equivalents to 22% of their portfolio, the highest level since Q1 2020. JP Morgan's Asset Management Division, according to their latest quarterly commentary from December 2025, shifted $18 billion from investment-grade corporate bonds into short-term treasuries and cash. Goldman Sachs' internal risk metrics, leaked to the Financial Times on January 11, 2026, show they've reduced gross leverage from 14.3 times to 9.1 times since September 2025. They're not exiting the market. They're de-risking, quietly, systematically, before everyone else figures it out. And here's the tell. The largest sovereign wealth funds are moving. Norway's government pension fund Global, the world's largest sovereign wealth fund with $1.6 trillion under management, disclosed in their Q3 2025 report that they reduced U.S. Treasury holdings by 8.4%, shifting into gold and short-term European government debt. Singapore's GIC, which doesn't typically disclose positions, had their allocation shift leaked in a Reuters report from December 18, 2025. They increased gold from 6% to 11% of their portfolio. That's an $11 billion shift into physical gold. When sovereign wealth funds move to gold, they're not chasing returns. They're protecting capital from currency debasement and systemic risk. Now I know what else you're thinking. If this is so obvious, why isn't it in the news? Why aren't economists screaming about this? Let me show you exactly why. The financial media doesn't report on systemic risk until after it explodes. They didn't report on LTCM until it collapsed. They didn't report on the scale of subprime exposure until Bear Stearns failed. They don't report on basis trades because explaining a basis trade requires 3 paragraphs of financial education, and the average news consumer won't read 3 paragraphs. Fear doesn't sell until the crisis validates the fear. Right now, we're in the it's contained phase. Reporting on obscure Treasury derivative strategies doesn't get clicks. But here's what's actually happening behind the scenes. The Financial Stability Oversight Council, which includes the Treasury Secretary, the Fed Chair, and heads of every major financial regulator, has been meeting monthly since September 2025 instead of quarterly. That information is public on the Treasury Department's website, but nobody's covering it. Their meeting minutes are classified for 5 years, so we don't know what they're discussing. But the accelerated meeting schedule tells you everything. They meet quarterly when things are calm, they meet monthly when they're worried. And there's one more thing. On November 4th, 2025, the Federal Reserve quietly updated their emergency lending facilities documentation. Specifically, they expanded the collateral eligibility for the standing repo facility to include a broader range of agency mortgage-backed securities. Why would they do that if they weren't preparing for a scenario where Treasury collateral becomes impaired? That's not normal housekeeping. That's crisis preparation. They're not telling you it's coming. They're positioning for it based on the pattern, based on the data, based on institutional behavior. Here's exactly what happens next. We're in stage 4 right now. The crack is visible but contained. Stage 5 begins when one of those 3 indicators flashes. Most likely trigger, the February 5th Treasury refunding announcement. If they announce another $1.4 trillion quarterly issuance, basis spreads widen violently. Margin calls hit within 48 hours. Hedge funds start unwinding. Move index spikes above 140. Stage 5, timeline, 7 to 21 days. From first indicator flash to forced liquidation, that's the historical average from 1987, 1998, and 2020. Stage 6, the death spiral, lasts 3 to 8 weeks. Forced selling, credit freeze, liquidity crisis, intervention. Stage 7, the wealth transfer, is already underway for those positioned correctly, but becomes obvious to everyone else 6 to 12 months after the crisis peak. The pattern says we're 4 to 8 weeks from stage 5 initiation. Not years, not months, weeks. So what does this mean for you? You have 2 choices, and this is not financial advice, this is pattern recognition. Choice 1, believe the institutions when they say it's contained. Keep your current allocation. Hope this time is different. Choice 2, understand that this time is never different. The pattern is absolute and position accordingly. Here's the strategic framework that has worked in every previous crisis. First, liquidity is king. Cash and cash equivalents become the most valuable assets during forced liquidation. In 2008, Warren Buffett had $44 billion in cash. He deployed it at the bottom, buying Goldman Sachs and Bank of America at prices that generated 10x returns. Not because he's a genius, because he had cash when everyone else needed it. Second, duration risk is your enemy. Long-term bonds are what's unwinding. Short-term treasuries, 3-month to 1 year, hold value because they mature quickly and aren't levered. In March 2020, 10-year treasuries dropped 6% in 2 weeks. 3-month treasuries stayed flat. Same asset class, different duration, completely different outcome. Third, real assets outperform during currency debasement. When the Fed prints $11.6 trillion, the dollar loses purchasing power. Gold, real estate, commodities, Bitcoin, assets that can't be printed, retain value. In the 18 months after the Fed announced QE3 in September 2012, gold rallied 38%, while the dollar index fell 8.2%. Not a perfect hedge, but directionally correct. Fourth, volatility creates opportunity, but only for those with dry powder. Every crash in history has been followed by the fastest rallies in history. The S&P 500 dropped 34% from February to March 2020, then rallied 68% over the next 12 months. But you can only buy the bottom if you have capital available. Forced sellers can't participate in the recovery. Fifth, credit quality separates survivors from casualties. Investment-grade corporate bonds held up in 2008. Junk bonds collapsed 30%. In a credit freeze, only the highest quality borrowers get funding. Your portfolio should reflect that reality. The time to check credit quality is before the crisis, not during it. Sixth, geographic diversification matters when systemic risk is concentrated. U.S. Treasuries are the epicenter this time. That means U.S. dollar exposure is your primary risk. Singapore dollars, Swiss francs, Norwegian krone, currencies backed by strong fiscal positions and low debt, outperformed during previous dollar crises. In 2008, the Swiss franc appreciated 18% against the dollar as investors fled to safety. Seventh, information asymmetry is your edge. The 3 indicators I showed you, move index, basis spread, SOFR spread, give you 72 hours of warning that 99% of investors won't notice until it's too late. Use that time. When all 3 flash, you execute. Not next week, that day. This isn't doom and gloom. This is pattern recognition. $4.7 trillion in hidden leverage. Same structure that detonated in 1987, 1998, and 2008, built into the foundation of the $29.6 trillion Treasury market. The math is absolute. The pattern is certain. The only variable is timing, and the indicators will tell you exactly when. 3 empires worth of financial history, same 7 stages, same inevitable outcome. We're in stage 4, moving toward stage 5. The basis spread is widening, volatility is rising, sovereign wealth funds are rotating to safety, institutions are de-risking quietly. The crack isn't hidden anymore. It's visible. The only question is whether you'll see it before everyone else does. You have 2 choices: position accordingly, or trust that this time is different. But remember, this time is never different. The pattern doesn't need your belief. It doesn't wait for permission. It just unfolds. Check those 3 indicators. Move index above 140. Basis spread above 15 basis points. SOFR spread above 20 basis points. When all 3 flash, the 72-hour window opens. What you do in those 72 hours will determine whether you're on the right side of the largest wealth transfer since 2008. Tell me in the comments, where do you think we are in this cycle? Are you seeing the same indicators I'm tracking? What's your positioning strategy? Because the next video breaks down the exact asset allocation that outperformed in 1987, 1998, 2008, and 2020. The specific percentages, the exact instruments, the rebalancing triggers. If you understand the pattern, you need to see that breakdown. Subscribe, because you cannot afford to miss this. The pattern is absolute. Thanks for watching.